Good morning, everyone. Welcome back. Today, before starting our in-depth analysis, I will quickly summarize the main takeaways of this video right here, since your time is precious. So, Union Pacific is one of the leaders in US railroad companies, with a good, reliable business, strong financial position, and a really good dividend track record with good management. Additionally, when looking at this DCF model, we can see that currently Union Pacific is near its fair value, and it can lead to really nice buying opportunities. Now, since the details of this model and the fundamental analysis is crucial, sit back and relax, and let's start with this video, as I can promise you will not regret it. And remember to like and subscribe if you enjoy the content, as it helps a lot and it's free to do. If you're new here, to analyze equities, I will use a 6-step valuation process which consists of the step shown on the slide. Additionally, the DCF model used for the price target will be available to download in the description below. So what is Union Pacific? Union Pacific Railroad Company is one of America's most recognized companies. It connects 23 states in the western two-thirds of the country by rail, providing a critical link in the global supply chain. And the railroad's diversified business mix includes bulk, industrial, and premium freight. Therefore, what are Union Pacific's operations? From the slide, we can see the major sources of revenues, which are freight revenues, which have 3 categories: bulk, industrial, and premium. Bulk includes grain products, fertilizers, food, coal, and renewables, which contribute to 33% of the freight revenues. Meanwhile, industrial includes construction, industrial chemicals, plastics, and many others, which contribute to 46% of the freight revenues. And finally, premium includes automobiles, automotive parts, and merchandise in both intermodal containers, both domestic and international, which contributes to 36% of the freight revenues. Consequently, Union Pacific's success drivers come from the company's growth strategy, which focuses on growing customers' value through innovative supply chain solutions and aspiring to serve, grow, and win together. And you can see the value creation circle on the slide. For industry analysis, it is important to understand the competition that Union Pacific currently faces. Union Pacific's main competitors are CNI, CP, CSX, NSC, and UPS in the industrial, railroad, and logistic industry. It should be noted that from the price-return graph in the last year, UNP has underperformed its competitors. And when focusing on the main players, we can see that across this industry, there is lower compound annual growth rate revenue growth, high gross profit and EBITDA margins, and we can see how Union Pacific excels in its return on asset and return on equity with UPS. Furthermore, when analyzing the dividends for this industry, we can see how Union Pacific, has good quant factors across the board, with good dividend growth, sustainable payout ratio, and decent dividend yield at 2.46% annually. For competitive advantages, Union Pacific has a lot. Firstly, it has its brand awareness that it acquired over the many decades of operating. Secondly, it has a strong operational network already in place in the US, which leads to a high entry cost for competitors, and UNP is a company that can be seen as still being the main player in the US in 20 to 30 years. Additionally, UNP has a very diversified revenue stream with a very experienced labor force, which led to a very nice and strong financial position that will be analyzed later in the video. Union Pacific CEO is Lance M. Fritz since 2015. He began his career in Union Pacific in July 2000, where before he worked for Fisker Inc., Cooper Industries, and General Electric. The value creation is on par with S&P since he became CEO price-wise. However, if dividends are included, Union Pacific outperformed the S&P since 2015. The financial situation of Union Pacific is healthy. They have a cash and cash equivalent of $1.31 billion with a total debt of $35 billion. The debt is high, but it is known that for railways company, the debt is higher than in most industries. However, it should be noted that UNP's debt-to-equity ratio is higher than its competitors, which is a weakness in UNP's financial. But Union Pacific has a covered ratio of 8.12, so even with a higher debt, it should not lead to long-term financial problems. There are 5 main risks present. The first is macroeconomic factors, specifically inflation and recession, that will hit the economy as a whole, and Union Pacific will be affected by slower earnings growth. Secondly, Union Pacific could encounter large strikes or work stoppages that can hinder their growth. Thirdly, Union Pacific is in an industry that's significantly regulated by governmental agency, especially for environmental laws. Fourthly, this industry is very competitive as there is a lot of competition from other railroad companies. Therefore, in the future, UNP could lose its edge. Finally, fuel prices is one of the key risks for this company. Fuel cost is a significant portion of transportation expenses. Therefore, it can lead to very significant risk for Union Pacific margin. The price target from the DCF model is $234 and the current price of Union Pacific is $211. And as a reminder, the DCF model will be in the description below for you to download for free. This is my Union Pacific 5-year DCF model, and this model yields a perpetuity approach value of 216 and an EBITDA approach value of 252. And the average being 234, which from the current price, it will yield around 11% upside. The inputs used to reach these values are, I extrapolated the revenue growth of on average 3%, so slightly higher than inflation. And for the cost of goods sold, depreciation and capex, I extrapolated them as a percentage of revenues, being conservative. And these assumptions led to these 2027 estimates of EBIT and EBITDA, which yields, using a 21% applicable tax rate, an 8% discount rate, and a 3% long-term growth rate, the perpetuity approach value, and using a 13x EBITDA multiple value, it will yield the EBITDA approach value. And this is my 5-year DCF model. In conclusion, Union Pacific is a good, reliable business. It is in a good financial position, and it is a strong dividend player with a good track record. It has risks, therefore check the risk and reward for you. And as a disclaimer, this is not financial advice, it is an analysis to give you a new perspective for a specific equity. But personally, Union Pacific at these levels offer a great diversifying dividend play with low risk and decent return. Therefore, I would wait for the scaling area and slowly accumulate. If you reached the end of the video, you're awesome. And if you enjoyed, please like and subscribe as it will greatly help and support the channel. Have a good rest of your day and I'll see you next time.